Rec-
Good evening, everyone.
Good evening.
Thank you. Welcome to the Account Solution webinar, Ask the Accountant. As usual, I'm going to introduce what this platform is about. The Account Solution is a dynamic learning platform that offers practical solutions to modern accounting challenges. This platform comprises of accounting professionals from diverse industries and at various career stages. It's a platform that serves as a hub for experienced accountants to share their invaluable insights while providing mentorship to aspiring accountants. With over 5 years of successful operation, this platform has played a pivotal role in helping numerous young accountants secure employment opportunities. Today's Ask the Accountant session is an open mic webinar where everyone can ask and answer questions. It's going to be interactive. And as we've said in our ads, no question is too big or too small. So let's feel free to present our accounting challenges, and collectively, we will all have answers to all the questions. So right now, it's my privilege to pass the reins of this webinar to Mr. Omar. He's a seasoned accountant and a career coach. He's also the visionary behind the Account Solution webinar. All right, he'll guide us further in this webinar. Over to you, sir, Mr. Omar.
Okay, good evening, everyone. Thank you, Bolanle, for the introductions. Today is open mic, and we expect questions. Please, I'd like the backend admin to advise those that are yet to put on their mic. Somebody called within the week, excuse me, and complained of not hearing us on this Sunday webinars. And I told her that it's possible that her mic is not selected, is not on. There are two ways on Zoom to put your mic. First is when you join a Zoom meeting, you connect with a cellular or with a kind of mic. Then second one is to mute yourself while in the call. So some people will join the meeting, their mic button will not be showing. That's the mic icon will not be showing. So ensure that when you are joining a Zoom meeting, your mic icon is showing. Otherwise, you cannot hear. So you might have to just keep admin, please always check participants if their mic, if you will see their video icon on, but you may not see their mic icon on. Just advise them with a chat to put on their mic icon. If they have a challenge, they can log out and log in again and try to select the mic icon when they are logging in. So today we'll be looking at questions people have been asking. And if you have any question while on the call, you can raise your hand with raise your hand icon, or you type on the chat box. For those on Facebook, you can as well type on the live stream and type your question on the live stream there for those on Facebook. For those on Zoom, just drop a question on the chat, or you use the ask icon, raise your hand icon and ask your questions. So we'll start with the questions that are here first of all. But as we continue, if you have any questions to ask while in the call, then you can as well, raise your hand or drop the question for us on the Zoom chat or on the live stream chat on Facebook. So the first question, which is pretty straightforward, how do I set up a small business accounting system? And this question keeps coming all the time, So in trying to address this question, just hold on, please. Sorry. This question keeps coming all the time, so we need to just look at practical ways to address this question. What to do when you start a business, what you need to do in terms of accounting. And I'll start first of all by advising that you understand the kind of business you want to go into. It's very important to understand that business. What is the nature of your business. Once you get that understanding, it helps you to begin to now understand how do you set up that business. So first of all, I would advise that you choose, for those that do not understand accounting principles, it's important to get an accounting advice from day one, right? It's very important. But if you cannot, that is all have this kind of webinars to educate you on what to do. The first thing I recommend anytime, any day, is first of all, understand the nature of the industry. So ask people around your industry, what kind of system do they have in operations? Once you get that understanding, then you begin to compile what we'll call chart of accounts. And let me not use that big word. It means begin to list out various, what are the items you're going to spend money on in your business, which could be, let's say, if I am into a big salon and spa, this spa, I need to get equipment for this spa. I need to get the equipment I need. Those equipment, we call them fixed assets or PPE. That, if you have furniture items, machinery, that's generator, motor vehicle, computer equipment, AC, all those things, we call them, items of property, plant and equipment or fixed assets. You have to name them one by one. So, and you categorize them into different names. For example, all the furnitures you're going to buy for that business, you call them furniture and fittings. All the equipment for the spa, for the salon, you call them maybe office equipment, or if they are, can you call them other equipment, or as the case may be, for those in that industry. Then for your computers that be used for administration, you can call them computer equipment. Now, I've mentioned 4 things now. Generator sets, I can call them plant, computers, computer equipment, furniture and fittings for all the office chairs, visitor chairs and tables. Once you begin to have an idea of all these things, they form what you call your chart of account. You're going to run expenses for fueling those generators, fueling the vehicles. You're going to run expenses for computer accessories. You're going to run expenses for your salaries, for office expenses, postage, all those things that going to affect your business in terms of cost. List them out. Now, there are 2 ways of doing this. There are some that, you want to have an extensive list. You want to know in details the cost drivers. So we have cost drivers and we have GL account code. The cost drivers are in details. For example, if I buy fuel for generator, I buy fuel for motor vehicles, I buy fuel for other things, I could just call everything fuel and oil or fuel, diesel and oil as one line item, as against having 4 line items. So the first thing here is to understand your business, what you are really into, and categorize your expense items, into what we call chart of accounts. Then your income stream also. For that spa business, you might sell makeup, you might do massage, you might do the spa, or let's say face painting or face lifting. You can just list those things into different income streams in that business. That become your revenue, lines in your chart of accounts. So it's having your account chart ready. That is, for me, starting point of any accounting system. Let's not go into details of how to structure it, but understanding what it simply means. If you make sales, where do you record the sales? If you make expenses, where do you record the expenses? If you collect loan from the bank, against what account should you record the loan? These are what you understand by your account chart. If you pay back the loan, against which account should I pay the loan? So all those things are what we call chart of account. And I like to explain also by using an Excel spreadsheet, which at least let's be practical enough, to avoid saying, oh, every day we'll come here and just get theories, no practical, So let's just look at the practical aspect. So let's say I'm into that spa business. Let's list out, we can call them account code. Ignore the code for now, it's not so important. We have the account name. So this account name is what we call the chart of accounts. You list them all out here. So let's say for a spa business, let's begin to drop ideas on the chat box. What you think? I think they may have, I don't know much about this spa. They may have services, we call it service income, and they may have sales income. Let's say they sell all these their what they call it, body lotion or natural body, all these skincare products, So you can just have these two items: service income, sales income. You can also divide the service income into different service areas. You can call it service income, can call this one the spa. Service income, you can have service income for different areas. You can call this one hair. Service area, you can call this one massage. Any difference between massage and spa? Service area, you can call this one, let's say, beauty or face lifting, whatever you call it. So this could be your income centers. So you have a list of this. So when you make sales or you render service along this line, you will charge the money on this place. You record it against this place, against here. And somebody asked me, how do I record this thing? I'm assuming you don't have a software yet, just setting up your system. Now you go to so we have your income. All these ones, we call them account class, just to jump the hierarchy. All these are income. All these are your income. You can also have sales income for different income centers. Like you can have sales for makeup items. You can have sales income makeup. Sales income. You can have let's say sales income for skin care, right? Skincare. These are all your income. You have started building what we call your chart of accounts. This is called my spa and salon, right? Chart of accounts. You can just have this thing, or you engage us. We are here to serve you. Engage us to do it for you, but you can just set up this simple thing. Once you have this, the next thing to look at are your expenses. Now you begin to list out different expense lines that you likely spend money on. And I can start from the assets. Can have the assets when you begin to buy your assets for the business. I can have so many assets here. Let's look at 4. We can have office equipment. We can have computer equipment. We can have furniture and fittings. And we can have, let's say, generator. Yeah, we can have other equipment in case there are things you cannot classify. So once you have this, once you buy any furniture, office desk, office visitors chairs, you record them against this line, this code here. If you buy generator, record against this code here. If you buy equipment, against this code here. So what we are just doing is simply structuring your accounting system so that once you begin to pull that information, you want to find out, for example, something to somebody into business, it's a fashion shop, and she can't tell you the quantity or how much she has sold or she has made in terms of skirt and blouse or shirts, single shirts or gowns, to understand, okay, what kind of clothing, do I make more in this shop, But when you structure a business like this, having an item, a tag, call it tagging, you tag all your transactions into different line items, GL code for those that are accountants, call it GL codes. Once you can tag a transaction to a GL code or to account code, then you're on your way to having, a proper system set up for your business. Can go to the expenses here, expenses, which will be longer by nature. You can have your salaries, you can have your postages, and let's say delivery. You can have your stationaries and any stationaries. And any expense item you spend money on, you can even have, it doesn't end. You can have a long list of expense item and still you keep adding to that list as your business progresses. So this is what we mean by having a chart of accounts in your business. It's very important to have it, as in, if you're using a notebook to write, using an Excel spreadsheet, Google spreadsheet, a software, you must understand these things and how they work. So now it's already asked me, how do I apply this in record keeping? I'll skip that. I hope to come back to that one on that question, but this is what we mean by account code. Let's ignore this code. Let me not start explaining how it works, but just codes that, if you're using a software, you have codes. Instead of typing this, just type the code or select the code, and you get your postings done. Now, let's move back to the slides on the questions. So I said, understand your business nature and the industry you're operating in, then develop a chart of accounts that will guide your business transactions. Then also determine what accounting method you will use. We have the cash basis and accrual basis, and I will explain it briefly. Now, cash basis is simply you record income and expenses when you receive the money. So if your customers buy product from you and they don't pay you, you don't record sales yet. It's until they pay you, you record your sales when you see the cash in your bank. They don't pay you, they don't record sales. That is what we call cash basis. I'll not go into details of the advantage and disadvantage, but the point is that if you wait until you receive cash to record your sales, it means you may be able to track your debtors. You can't track when these sales are actually sold. When the product exchange hands, you can't track it. So we have the next one called the accrual basis. Accrual basis what we recommend in most businesses in terms of standards. And it means that income is recognized when transactions are exchanged. And I don't want to go into IFRS 16 right now, talking about of income. Let's not go into that details now. The point simply means if I make sales now, whether I get payment or not, I'll record it as sales. As long as I've delivered the product or services to the beneficiary. Somebody has enjoyed my service. Once they've enjoyed my service, in fact, that's the easiest way to explain IFRS. Once they've enjoyed the service, they've accepted the enjoyment, they have my invoice. At that point of invoicing them, and they accept the invoice, it becomes sales. Whether they've given me money or not, it doesn't matter if they've paid for the services or not. As long as they've received value for that transaction, then it is a sale. So that is what we mean by determine the method you want to use. And I must say this, it's good you use accrual basis, but if it will give you a problem, the SME, you can stick with the cash basis, but we recommend you use the accrual basis. So after that, first of all, I said, understand the nature of the business you're going into, the industry. Number two, create a chart of accounts. It means your income lines and your expense lines, create them in a table, and you need to charge the tag transactions to those chart of accounts. Then number three, you determine the method to use, either cash basis or accrual basis. Then after that, next thing is to start posting. Of course, you should have a bank account. That one is for those that teaches entrepreneurship. This is a business. You should have a bank account for that business. So that will be tied to your chart of account as well. Then you now start recording these transactions. So recording simply means posting to your QuickBooks, to your Xero, to your Sage, or to your spreadsheet, either on Google or Excel, or to your books, your notebooks, whatever you have. People wonder, why do I still keep using this word, notebooks? Yes, there are so many companies now that don't have accounting system. They are doing well, as in they are doing big business. They don't have even the simplest spreadsheet. They don't have. They also have books, and I know them. So I keep using the word, either your book, notebooks, your standard notebooks, your spreadsheet on Google or on Excel, or your softwares or your ERPs. Whatever the case is set up your system by understanding the nature of business you're going into, then develop your account of accounts, Then you are determining the method you want to use, either cash or accrual basis. And then you also start recording your transactions. Of course, you must have your bank account. Now, if we have the questions on the chat box, we'll take them either on the live stream, also take the questions as well. So next one said, is there any advantage consulting an accountant before starting a business? Yes. Yes. The reason I said yes, because I was talking to a colleague some time ago. I said, we need to start having conversation with CAC, with FIRS on startups, because a lot of startups just go into the technical aspect of the business, open CAC, then start your business. It's after a year or two, we need to now begin to set up systems for the business, or begin to ask questions around taxation. What do I file? What do I need to file? It's important, as in, I'm not trying to promote accountants or to say you must use us. No, it's important. Once you conceive a business idea, it's important you talk to an accountant and a lawyer as well, if you have the resources, because they will guide you. They will guide you. A lot of benefits, you derive when you talk to an accountant, right? One is because there are so many regulations, so many acts that affect a business. I'll give you some examples. Now, if you start a business limited by liability, we have what you file every year. You file your ITF, you file your NSITF, you file for PENCOM if you have, I think, up to 5 or so employees. I'm not so sure right now again. You file for your payee, annual returns. You file for what again? Your FIRS, that's EDT, and your tax. If you're up to that threshold, you start filing for taxes. You file for which is that one again now? You file for CAC. So you have so many exposure, so many liabilities you're exposed to once you open that business. You have monthly VAT returns, whether nil or no nil. Whether you are doing business or not, you have to file these things. So you need to understand that accountants help you to structure your business before you even go into that business, and even advise you on what to do in terms of your accounting system. If you're into real estate, when do I start posting my sales? For example, your customer pays small. If you're into real estate, they pay small. And you are selling that plot of land for 1 million naira, and they've paid you like 5 times. At what point do you recognize income? At what point do you take your profit from that land, that plot of land? So you need to structure your business model, structure your accounting system around the business model. So once you start that business, you will not run so far and now realize you have to start keeping some basic records. So it's very important that a lot of businessmen and women end up using their personal funds to start their business, what we call preliminary expenses, and they can't account for those things. In the near future, they want to do the accounting. They can't account for all they've spent in that business, and they'll be paying more taxes based on their profit level. So it's good you consult an accountant before you start that business. It helps you to know areas to focus on. It's open mic. If you want to contribute, please raise your hand. You can speak. I shouldn't be talking alone. It's open mic. Contribute to the questions. If you have an objections, say it. If you have anything to chip in or questions to ask, it's not a lecturing seminar. It's a conversation. The reason we have these questions come before now is so that we won't have people are shy to talk or ask questions in public. So we'll get them ahead of time and try to address them. But if you have questions, we're on the live call on Facebook, on Zoom. You can also pause us and ask your questions. Raise your hand. We'll unmute you, or you type your question, someone will pick it up and answer. Now, somebody asked if it's recorded. Yes, it's recorded. It's on Facebook Live. It's also be on YouTube. You can access them there. Okay. Is there a threshold for filing annual return? So now it depends on the authority you are filing to. For ITF, NSITF, CAC, there's no threshold though. In fact, ITF and NSITF, there are more danger zones. Let me not go into that issue right now. There are no threshold. Just do your annual returns. In fact, for ITF, for NSITF, you even pay some money to them. You know, even if you like argue you have to commence business, you don't have employees, they want you to pay some money. So it's another ball game entirely. But for FIRX, you have to file your returns annually. No threshold in that case. Filing return does not mean you are paying taxes. Do you understand? It doesn't mean you're paying taxes. Just file your return. It is in your filing returns on tax promas that the state will determine if you have to pay tax or not based on your turnover. So you have to file your annual returns, whether you're in business or you're not in business, you should file your annual returns. All right. It's very important you do that as a business and owner. Okay, so moving on. I was in an online webinar for entrepreneurs, and one of the speakers mentioned matching principles. Can you throw more light on the term? So for matching principles, it's basically along the line of what I've explained before, which has to do with accrual basis, kind of. It simply means you are matching revenue and expenses in the period they occur. Please, accountant in the house, if I miss Yan, just help me and correct me. You know, so the reason for matching principles basically is trying to, you know, recognize income, recognize expenses. Because let me give you an example now. Let's say somebody bought goods from you in 2022 December, and person paid you in February the next year. Now, if the cost of running that business in 2022 has been charged to that year, the purchases you made, the cost of the business has been charged to that year. And now the income was, you sold that goods in that year, but you receive payment in the next year. If you post the revenue in the next year, you're not matching revenue against cost, because the cost of running that the purchases or the direct cost of that sales was charged to 2022, but the sales is in 2023. So you're not matching your sales and revenue correctly. I don't know if I'm making sense. Accountant in the house, help me. You know, you're not matching them, you know, correctly. Yeah, I'm not showing my screen again. I'm just talking, you know. So that's what matching principle means, basically. And I'm trying to explain it further. Let me try and read something out from here so that I'll use accounting words. Okay, so it's a concept in accrual accounting. So when you're using accrual accounting and not cash basis, we discuss matching concept here. You know, businesses should match related revenues against related expenses in the same period. So the period in which you incurred the cost, let's say you purchased 100 items, you know, and you sold those 100 items in that same year, but you receive the money the next year. It is the year in which those items were purchased and sold that you should recognize that particular income. So that what I mean by matching concept. And in accounting, typical examples can be somebody's asking for AI companion. What does that mean, please? Who is Victor? Who is Victor? Victor C. Please, won't allow any AI here, please, because we had a bad experience in the past. Somebody hacked into our system and did some nonsense. So please, we restrict a lot of things on Zoom here, please. Sorry. Thank you. So basically, items like salary and wages, let's say as of 2022 December, you've not paid all your staff salaries. And they've done that, they've worked for that year, they've raised revenue for that year, we are paying them the next year. You are not going to charge that salary for the next year account. You will charge the salary in the year in which it was, you know, incurred or accrued for. You know, so that will call matching principles. I don't know if somebody in the house can throw more light on this. Anybody in the house want to throw more light on this concept? Somebody is asking, what does it mean? Throw more light. I'm saying it simply means all expenses and all income that has to do with a particular period should be charged against the same period. You cannot charge the income for this period in the next period, then it will be a problem. Okay, so that will call matching concept, matching principles. The floor is open for any contribution. The floor is open. Now, what if for, let's say, somebody, you are doing a contract, for example, and the contract was awarded in 2022, and it's going to last 2023, 2024. And most of the equipment you need for that contract has been purchased in 2022. Let's say you've bought all the materials you need for that contract, but it's in phases, in milestones. 2022 December, you have to complete that assignment. And you can only invoice for what you have done, like your percentage of completion, or based on your job done so far. The customer can only pay you the milestones you've achieved. So in that case, now how do you recognize the sales? Are you going to charge the whole cost for that particular year or not? So in that situation, what I would do as a person, or what is advisable, is that you have purchased all the items you need to finish that project, but as of that 2022, you have to complete the project. And you can only invoice the ones you've done, the percentage you've done for that year, can only invoice that percentage. What I would do is to apportion the cost, based on the milestones achieved, so that cost will be charged in 2022, and the remaining cost will be charged in next year when I'll finish the job and do my final invoice. That's what I would do in that situation. So you could have some cases where it's a bit complex for you to match your expense against your revenue. Okay, so next question: how do I know when to capitalize or expense an item? Okay, so this one, it depends, first of all, on two things. One is nature of items or type of items purchased. Then two is policy of the company. Now, type of item purchase. If you pay for computer accessories, for example, like what do they call themselves? Like USB, that's flash drive, or let's say cables, power bank, and the rest of them. Those kind of consumables shouldn't be assets. Honestly, they're consumables, right? But it depends on policy now. The company can say, okay, our policy is to expense any item of PPE, because the issue of capitalization comes when you have to do with PPE in the first place. You can capitalize fuel and oil. You can capitalize stationaries or transport or salaries. No. So when the word capitalize come, it means what should I carry into my asset register as a capital item? Which items that will live beyond 1 year? It has to do with the type and the policy. For policy, you must have a policy for your organization. Policies can come in two ways. One is threshold of amount. Okay, any equipment, any asset, anything we buy below 100,000 naira, expense it. That's a policy based on amount. Any item that is below this amount of money in naira or in dollars or in pounds, expense them into your profit or loss account. Don't capitalize. Don't put into your fixed assets or your PPE. But any item above 100,000 naira or $1,000, as the case may be, you have to capitalize them. Means they are now items of property, plant, and equipment. They are now your assets in the business, so you can't expense them. Some will say, okay, what of all those cutlery, spoons, plates, pots, and the rest of them? All those things. Again, policies. They are what we call, you can actually group items together. If they are very small, you can group them together and call them other equipment or kitchen equipment. Maybe if it's grouped together, it becomes significant to the business, then you can capitalize it. Again, based on company's policy, you must have a policy. You must have a policy of what you are to capitalize or what you are to expense. It's very important. Now, there is a caveat here. There are some organizations that will say, okay, anything above 150,000, please expense it. However, if that item is attractive and can be stolen, then capitalize it. So let's say when Nigeria was still good, you can buy a good smartphone for 150,000 or 20,000 naira. Maybe in your asset policy, 20,000 naira below is to be expensed. But because that smartphone is an attractive asset and contains vital information, can be stolen or misplaced, then the company is saying capitalize such items. So there are always caveats to these policies, and some of them are based on best of judgment, but you must have a policy that will guide your business in terms of expenses and in terms of assets. There's a question on Facebook. Can someone read that for us? I don't know if any of the admins can read from Facebook, so I don't have to change my screen. I saw a question drop on the live stream now. So if you get the question, please, either Bolanle or Angel, please try and read for us. So the next one, please, you can still react to the past. If the company has no policy, what should be the standard approach to collection of assets? Okay, if the company has no policy, what should be the standard approach, capitalization of the assets? My advice again is, please, once there is no policy, develop a policy. Develop a policy. If you realize there's no policy today and you're buying an asset, quickly develop one that will guide you. Also, look at the history of the assets in your asset register. Look at the historical cost of those assets. What is the least threshold there? That can also guide you, in developing that policy. So if the company has a policy, what should be the standard approach? I'm saying, look at if they have asset register in the first place, look at the asset register and look at what is there in terms of the category of assets they have there. How much is the cost if you have those breakdown? If you don't have them, again, it depends on the lifespan of that asset. For example, if it's asset that is based on IS 16, I guess, look at the calculation criteria for IS 16. That asset can be used beyond 1 year in that business, all right? Can be used to generate revenue for that business, beyond, as long as if it meets the calculation criteria under IS 16, then the standard approach. So even your policy document should be based on the standard. That's IS 16. Should be based on that same standard. So your policy should not be a departure from the standard. Even though we say threshold, you must also look at the standard, in your IS 16. And what is it saying in terms of PPE? Then you know when to capitalize an asset. Okay, so if you are employed by a company that has capitalized every item, what should you do? It depends on what they capitalize. If they capitalize every item, again, you have to recommend to management to develop a policy, right? Develop a policy that will guide the asset capitalization going forward. The policy will also enable you to know if you are to expense anyone, or just leave it the way they are. But it's based on policy, and policy is tied to the accounting standards, which is IS 16. So if you are going to a new company and they already have assets, they have everything in the asset register, you also advise them to develop a policy, looking at what they have on ground. The policy will also guide you to know if you are to expense those items that are already capitalized or not. So again, it's based on different organizations. What can I do? Developing a policy and standard internal control, but employees disregard it and management encourages it. One-man business experience. So for one-man business experience, you cannot do more than what the management wants, I still recommend you develop the policies, give to management. If management overrides your policies, do you understand? If management overrides your policies, then at that point, I don't know what else you can do, right? I don't know, because management override is a very strong internal control axis. I don't know if it's something somebody can answer. That's an experience. If you develop these policies, internal control policies, and management don't encourage people to adhere to that, I don't know what you can do again. As in, you just keep trying and recommending to management that these are very important, they're very important things they need to do. So I have someone's hand up. I have whose hand is up now? I have Eunice's hands up. So please unmute and speak, contribute, ask questions. Go ahead, please.
All right. All right. Good evening. I want to answer in response to Gabriel's question. Now, speaking from a personal experience, when you develop those policies and there's a management override, no problem. A company cannot rise beyond the management or the owner or the CEO. But those policies serves as a safeguard for you in case of tomorrow when issues comes up. You know that, okay, these and these are what I have said about these issues, and these are the policies I have given to management. You've done your bit, you can't do more than that. So those policies are just your safeguard. That's what I can say about it. So you can't enforce it. It's management's role to enforce it, but it guides you on how you carry out your role in that organization. That's from personal experience.
Thank you. Bolanle, your hand is up, Bolanle.
Yes. Okay, before I ask, it's a question I have. Before I ask the question, I just want to encourage everyone, this open mic session, please feel free to raise your hand so that we can hear your voice. Use the mic. So I want to take us back to the question on invoicing for projects. So the right thing to do, right, correct me if I'm wrong, is to invoice based on to raise the invoice when the project is completed, right? Or as you're raising the invoice based on what has been completed. So if you're in a situation whereby you're asked to raise an invoice even when the project has not been completed, because the salespeople want to see that their revenue is they are meeting up their target, so they want to see the sales increasing, even though the projects are not completed. What do you advise an accountant to do, and what effect would that have on in the books? And what effect would it have in the books, positive and negative?
Okay. First of all, I think anything about revenue should come from IFRS 15. Revenue from contract with customers. That standard should be looked into. So the argument you put between you and your salespeople is based on that standard. Nothing left, except people have not adopted IFRS in your company. So if you are adopting IFRS, you have to look at that standard. What is that standard saying in terms of revenue from contract with customers? I think that will answer your question. Do you understand? Anything you are saying outside the standard will not work, right? So it's very important we understand that standards guides transactions in accounting. You understand? And one of the key points in that standard is performance obligations. It's a very important keyword or a key phrase in that IFRS 15. I don't have everything in my head right now, but that's a very strong key point. What determines when value is done, pricing, considerations, and the rest of them. So that is my answer, first of all, to you, is based on IFRS 15. You need to look at that standard and understand what the standard is saying, because for performance obligation, we're looking at what point is obligation satisfied, when you transfer a promised good or service to a customer. Do you understand? So you cannot say you satisfy that obligation when you've not transferred the promised good or service. The promised good or service here could be the total, the overall project, or could be in milestones. So it depends on how the contract is structured. Is it based on milestones or based on completion of project? So you need to look at all those things. But based on performance obligations, you need to look at what point is that promised item, that promised service, that promised goods, transferred to a satisfied customer. You understand? That is what you need to do. And if it comes to that, you need to look at find an appropriate measure to determine the progress, of work done. Do you understand? The progress of work done and how much you should recognize as performed obligation. So if at the end of December, like want to post sales, to what extent of this project, to what milestone have we achieved? Can we invoice for that milestone achieved? Because they've received value for that milestone. You cannot invoice for the entire milestone when the customer is yet to receive the promised item or the promised goods based on IFRS 15. Let me not talk. Let me just stop here. I don't know if I answered your question, Bolanle.
Yes, you did. Thank you.
Okay, so anyone want to ask or make a comment or answer something, or if I've not answered your questions correctly? There's somebody on Facebook posted something on Facebook. There are 2 questions on Facebook. Don't know how to get those questions now. Someone should help us with those questions. Okay. Proceeds from sale of land and buildings are VAT exempt in line of Finance 2020. I want to ask, what about commissions from sale of the above assets? Are they VAT exempt? And commissions are VATable. So sale of land, first of all, there's no VAT on sale of land. So the question now is commissions. Answering this question is maybe it's all these sales agent from all these real estate companies now. So VAT, can somebody help us please in this question? VAT from commission on sale of land. Let me not answer straightforward now and hit rock. VAT from, first of all, VAT on land, there's no VAT on land sales. But let's say a real estate salesperson was the marketer that got the buyer to buy the land. Then the company pays the guy 10% of the proceeds from the sale of land. That 10% now, should there be VAT on it? I don't think so, first of all, but I need to check the Finance Act, the recent ones, but I don't think so. But I think that they can deduct withholding tax from that commission, but I don't think they should. Because are you the one issuing an invoice to the real estate company to pay you VAT? I don't think so. Because in this case now, the money is paid by a customer to the vendor. The vendor is one that will put the VAT on the invoice for the item. So there's no VAT for the land being purchased. So I don't think there should be a commission, on that, except the sales agent is issuing an invoice to the company that sold the land, invoice for the commission. Because I know most of these sales agents, they don't issue invoices. Once you make sales, you pay your commission, and they can deduct withholding tax from your commission and pay to you. That's my opinion, without looking at any acts. I don't know if anyone has anything to contribute. I don't think there should be VAT on that commission. I could be wrong at this point, but I think what we only apply is the company paying the commission should deduct withholding tax from the sales agent's commission and pay them the balance. But there should be no VAT, on that service. Because what you're saying now is that the company will pay VAT to the sales agent who will not remit the VAT. It's not applicable. Sorry. Gabriel, your hand is up. You can unmute yourself. Gabriel, please unmute.
Okay, good evening.
Good evening.
Yes, sir. So thank you for this webinar again. So my question earlier, I just want to maybe add throw more light, maybe those on call will also learn. Is part of what we face when working with a one man business. The issue of policy and internal control I made mention of is a company I joined, and it's more or less a startup, but I can't call them a startup again because they are already 5 years. So there are things going on which are not, for me, as an accountant, is not proper in terms of when it relates to finances. So I could remember a day in the meeting, I suspected one of the staff, doing some things in terms of, how would I put it, charging or collecting more money, more than what is expected. And as a finance person or as an accountant, I noticed that. I raised the alarm in the meeting at the management level. It will surprise you that the owner will be able to say, Gabriel, you cannot stop people from stealing. Telling an accountant such thing openly. If not that, some of us have the fear of God. And another noticeable thing is that staff will go straight to the management to get approval without following due process, no procedure. And when there is a budget for a project, they just send budget, no defense, no review from the finance and account, but spending is already ongoing. And just any policy you try to put in place is being frustrated by the action and inactions of the management. And what can, as an accountant who want to protect his image, because definitely if an external auditor or an external person is coming to review the 610, definitely they will say that there's an accountant, why are these things not in place? So that is my experience, and I don't know, is it
Okay.
I'm not challenging them, but is it a good thing, or what's the best thing for a professional that want to make impact and to also keep his image and integrity intact? What can one do? That is my question. But for the area of commission you explained earlier, you are very correct. Commission is not subject to VAT. Rather, it is subject to withholding. Thank you.
Okay, so just like Mrs. Eunice mentioned, these things, I once did audit for one Lebanese company in Port Harcourt, and I raised I raised plenty audit queries and audit journals. Went to meet the MD. So I went to meet the accountant, and she told me I should go and meet the MD and the cashier, that are both Lebanese brothers. And there's a phrase they use in that company: person know the thief himself. Person know the thief himself. That money from this pocket to this pocket is the same pocket, the same trouser. So it comes down to the point where you know that this is a one-man business and you can't do beyond what the owner wants to achieve. So document your processes, put things in place, your controls, put them in place. If auditors come tomorrow, what are your controls? Show them. Write reports, write recommendations, give to management. I'll tell you a story. The client who audited in the past, we keep sending management letter every year, but the MD was not looking at those management letter. No action point was being addressed. Every year we recommend, point they should address in internal control. Every year they will not do that. So one year they had a case with EFCC, and we are called as auditors, and we have been accused of not doing our job. And we showed them all the years, over 5 years of management letter written to them, and those issues were addressed in those letters. And that was what exonerated us as auditors. So you have to do your reports, internal control weakness, document it, and profile solutions, and tell them the benefits if they, start doing this way. All right. So it's very important you document all those things and keep presenting. One day, the Pharaoh that knows Joseph may come, and all you've documented could be of help, in the business. That's what I would advise you to do. Someone is asking about last week question that I listened to the last week recording and got more confused. So Johnson Edward, I can't remember the particular question I'm talking about. So please, we're already behind schedule. If you can just chat to us on WhatsApp, ask that question again. We'll explain the answers to you again. If I can get you correctly, it's about the invoice A and invoice B, where a company sponsored another company for training. That's one I can remember that has to do with invoicing. Please, you can just chat me up after now, and I'll address that last week recording for you again. So to wrap up tonight, it's already 9 o'clock. There's a question that's very important here. Very important question. Let me just explain the question here. Somebody stepped in 2014, but not registered. Registered in 2014, but has not filed, tax returns all these years. So 2014, 2016, the person was operating in his personal account. But 2016, the person opened a bank account in that business name, but yet to file any tax returns. And the person is asking, where do I start from? Now, there are a lot of companies like this. In fact, I know of 3, currently having the same issue. They've done business for over 5, 6, 7 years. They are yet to file any returns at all to tax office, and they want to start doing that now. The truth is that there are penalties to pay. Your penalties for all the years you've not filed, that's late penalties. And it is calculated by the tax POMAS now. So you have to, first of all, start from your TIN. Do you have a TIN? If you have a TIN, do you have a profile on tax POMAS, which is the engine for FRS filing now? So go to the tax office where your TIN is domiciled, open a file with them. They'll ask you for your CSC documentations, ask for your bank statement, ask for everything. Open a file, then update your profile on tax POMAS. They'll give you your login details. You now have those login details. You now file your returns for those number of years. But the problem is that the more years you've stayed without filing, the more penalties you pay. So I think you should consult a tax consultant at this point to advise you. I won't say it on air, but there are ways to, do these things. But the truth is that if you are filing for all the years you've not filed for, you have to pay penalties for those years, and you pay those taxes depending on your threshold, if you are SME or above SME threshold. But the starting point is to check if you have a TIN, and if you have your updated profile on tax POMAS, then you get a tax consultant who will advise you, because you need to pay your account. You need to file your audited account for those number of years on tax POMAS before you start applying for tax clearance certificate. However, somebody advised me one time that it's best you just file for 3 years, for the most recent 3 years, and allow them to come and do audit. So it depends on your approach, right? Depends on your approach. But the truth is that you have to consult. You have to consult someone. Please, you have to consult tax expert before you even approach them, because if you go there alone without being informed, these people will call Chirewere accountants, or all these people that want to be fun, they can use you and make money, but they open business on your head. So try to approach a tax consultant. It's not that very expensive to get advice, or you go online and Google, but don't go there without being prepared. You have to understand what you are going into, right? Because it's a very serious issue. Eunice, want to say something? Eunice, want to chip in something at this point? Hello, Eunice. Have we lost her? So please seek advice at this point. But the truth is that before you get tax clearance, you must file your returns, and you pay the relevant tax.
And remember that you can always watch this. You can always listen and watch this webinar over and over again, to be available on Facebook, and on YouTube. So thank you for once again. We'll continue and we'll do this again next week, same time, same platform. Thank you again, and have a beautiful evening. Bye.
Thank you, everyone. Next week is HR, so please share the link to someone. We're discussing conflict resolution in the workplace next week.